Tony, you were talking a little bit about maybe getting positive on Wells Fargo. Walk me through that thesis again.
Well, this was a quarter where, first quarter of the new CEO. We think they're in a regulatory cleanup period of time. As things go from bad to better to best is when the stock gets revalued. So you're looking at a Wells Fargo at, I think, 12 times thereabouts earnings, price of earnings. That's atypical for it. It typically is traded at a premium. It might take a while for it to get back to trading at a premium for the bank peers, but that's a good thing. That's when you want to own the name as that kind of gets resolved. So it's a great franchise. They've got lots of opportunity. As you saw in the quarter, they've got a lot of, I think probably low-hanging fruit in terms of expense management to right-size the ship as they prepare and get this regulatory behind them. So I think that's all positive for it, and you're able to buy it at a bargain price. Look, step back just a second here. I saw something about a week ago. It said that the average loan-to-deposit ratio among banks is 70%, okay, right now. That is the lowest since it's been since 1985 when they've been able to track that. In other words, banks aren't lending versus the amount of deposits that they've got. They're overcapitalized. So as that comes unwound, and that will happen as the consumer starts to take on more risk into their pocketbooks. David was just talking about it. The velocity of money is on the floor. The household debt service ratio is at the lowest levels you've seen since 1980. So there's ample room for this to be taken on, and Wells Fargo should be a beneficiary of that.